A few years ago, a woman from Phoenix, Arizona borrowed $500 from a payday loan service after her husband lost his job, and soon it would destroy her life. Because in just a few years, that $500 loan would end up costing her over $10,000, trapping her in a cycle of debt she couldn't escape. This is just one example of the way payday loans wreak havoc on millions of Americans every year. Before we can understand how payday loans can trap someone in debt, we need to understand what they are. Payday loans usually range between $50 and $500 and typically have to be repaid in a couple of weeks. And they have incredibly high interest rates, sometimes going up to 700%. Payday loans APR is so high, largely because it combines loan origination fees, service fees, and interest. This leads to a vast majority of people who get a payday loan being unable to pay them back in a few weeks. People like Lisa, Sandra, Arthur, and many more all applied for payday loans for different reasons, but sheer desperation was the undercurrent in every story. And in the end, they all ended up in the same place, financial misery. That started with a loan for a few $100. Their stories represent a tiny fraction of the story too, because every year, payday lenders earn $9.8 billion in late fees and interest payments. And before you think, hey, they should have avoided those loans in the first place, let's look at a scenario that is trapping so many people in these payday loans. Meet Sam. While on her way to work, her car breaks down unexpectedly, but she isn't getting paid for 2 weeks. Unfortunately, she doesn't have the money in her account to pay for the repairs, so she needs to get a loan. And this is a common scenario. According to the most recent statistics, the average income of a payday loan borrower is $30,000. With 58% of these borrowers unable to cover monthly expenses, a car breakdown is a nightmare. The problem for Sam is that her low credit score is stopping her from getting a loan with most loan providers, and she needs the car now so she doesn't get fired. So she racks her brain and remembers seeing a sign for payday loans and how she can get money fast regardless of bad credit. And this was just the first little trick that these loan providers use to lure her in. Payday loan providers know that many people who need money have low credit, and that's why if you go to one of their offices, you'll probably see a sign in the window that says no credit check required. Since Sam has very limited options for financial help and doesn't know where else to turn, she applies for a payday loan and gets the money the very same day. She gets her car fixed, gets back to work, and is back to business. Hooray! Crisis averted, right? Well, no. The problem is, the interest rates of payday loans can be much, much higher than traditional loans. Like I mentioned earlier, sometimes they can get up to nearly 700%. With payday loans, the goal is to pay them off as soon as possible, and every day that the loan accrues interest, it only gets harder and harder to pay it back. So, if Sam can pay everything back in 2 weeks, great. But if she can't pay it back in that short amount of time, then she'll likely end up in what's referred to as a cycle of debt. Let's say Sam's loan amount is $1,000. Her interest rate is 700%, and her repayment term is 14 days. That means in just 2 weeks, the $1,000 she owes has now become $1,268.80. That's an additional $268 of debt on top of the $1,000 she borrowed. This creates a big problem for Sam, who even after paying off the initial $1,000 on time, still has to deal with the growing $268 in debt. And this isn't an outlandish story. 80% of people taking out payday loans are unable to completely repay within the first 2 weeks. So each week Sam isn't able to pay back the loan, the debt continues to pile on faster than Sam can pay it off. In Sam's case, her loan would double every month. What often happens in this case is people like Sam turn to a second payday lender for help, maybe even a third if they still can't keep up with interest or fees. And you want to know the craziest part of the whole thing? It's the fact that people get trapped in this cycle for so long that they end up paying thousands more than the original loan amount. Lisa and Jelkins, a single mother making less than $8 an hour, once took out a payday loan for $300. She ended up paying $1,254 in fees to renew a payday loan 35 times, and she wasn't even paying off the original loan. It was going to cover interest and fees. That's more than 4 times the original loan. Arthur Jackson, grandfather of 7, went to the same Advance America payday shop for over 5 years. His total interest paid is estimated at about $5,000 for a loan that started at $200. Advance America flipped the loan for Arthur over 100 times, collecting interest of up to $52.50 for each transaction. His annual interest rate was in the triple digits, and he filed bankruptcy to save his home. So even though payday lenders are recouping way more money than they're lending out, payday loan borrowers are trapped. It's no wonder why 18 states have effectively banned payday loans or placed huge restrictions on them. And California, Arkansas, Connecticut, and New York are just some of the states that have put caps on the maximum interest rates of payday loans. Let's take a look at the average interest rate for each state on the map here. Texas here leads everyone at 662%, while on the lower end, we have Oregon at 140%. But the question remains, what could you do if you're in desperate need of money fast, but you want to avoid a payday loan at all costs? Well, if the option's there, ask friends or family for a loan or some assistance. But since many of us don't have that option, which is why we're turning to loans anyway, there could be better payday loan alternatives, even with bad credit. We actually have a list of them in this video, and we've got an upcoming video where we compare the different types of personal loan options. So subscribe for that. Don't worry, I'm not going to leave you without an answer. One alternative to payday loans are installment loans. Borrowers with bad credit could get approved for both installment and payday loans, but they have a few key differences. For starters, installment loans typically have lower interest rates, longer repayment plans, and higher loan amounts. I should point out that installment loans exist for people on the entire credit score spectrum. So even though someone might get rejected by lenders with minimum credit score requirements, there are still options available for someone who has a credit score below 600. Installment loans are typically just as fast when it comes to getting money in your bank account too, often delivering funds in either the same day or the very next business day. So when you're getting same-day payouts but with longer repayment periods and much lower interest rates, installment loans could be a better alternative. You might have noticed that you're watching this video on the CreditNinja YouTube channel. CreditNinja only offers installment loans, not payday loans, and they're focused on helping customers with less than perfect credit scores. CreditNinja offers loans between $300 and $5,000, with repayment periods that are usually between 4 months to 2 years, not 2 weeks. They don't require a minimum credit score to apply, and they use what's called instant bank verification, or IBV, to make loan approval decisions instead of solely relying on credit scores. IBV essentially verifies your banking info and proof of income to confirm that you can pay back the loan. And in case you're wondering, out of all of CreditNinja's existing customers, nearly 40% returned to CreditNinja when they needed a second loan for another emergency. Plus, while most payday loan providers have tons of bad messages written about them online, CreditNinja has thousands of 5-star reviews on Trustpilot. Check out our What is CreditNinja video to see just how quick it is to apply for a loan and get your money on the same day. Or just go to creditninja.com and learn more there. Payday loans may seem like a quick fix to financial problems, but they've actually created a financial crisis for people across America. My hope is that this video shows you how big of a problem they can create and what you could do to avoid this cycle of debt altogether. Hey, thanks for watching, and we'll see you next time.